Objectives. At the end of the lecture, you must be able to describe the different types of intermediate terms financing, explain the terms and condition for each type of intermediate term financing, explain the advantages and disadvantages of each type of intermediate term financing, lecture outline, introduction, term loan. What is a term loan? Classification of term loans, factors influencing the terms and condition of a loan, other features of a term loan, financing costs. Hire purchase. What is hire purchase? General characteristics of hire purchase, other features of hire purchase, financing costs. Listing. What is listing? Other features of listing, financing costs. Intermediate financing is basically has time frame of about 1 to 5 years. Introduction. The intermediate source of financing. So the loan with obligation to pay between 1 to 5 years to buy equipment. The three common types are term loan, hire purchase, and listing. Term loan. What is a term loan? Loan used for various purposes. Terms and conditions may differ from one loan to another, such as tenant, principal amount, interest rate, currency, current ratio, or leverage ratio. It is negotiated directly by lenders and borrowers. Factors influencing terms and condition. Creditworthiness, the 5 C's: character, capital, capacity, collateral, and conditions. A borrower with higher financial standing will obtain better deals such as lower interest rate, better terms. The reason is because the borrower has lower risk of default. Purpose of the loan. For working capital, for example, CA minus CL, or general use. Purchase machineries or buy a factory. Fund a project, then the bank will consider the project risk. So it can be for many types of purpose, such as building hospital for government. Types of lenders. Insurance company can be lending out money. So they provide longer terms loan and a demand higher interest rate. Commercial banks. Very competitive. Lending is their main business. They give both long and short terms loan. Hire purchase is a contractual agreement where hirers pay a down payment plus installment to hire the use of an asset and option to purchase the asset at the end of the hire period. For example, car belong to the user on paying the last installment. Cots, furniture belongs to the user on paying the last installment. General characteristics. Terms: assets down payment or interest. Duration: hire purchase probably 1 to 5 years, about the range of 1 to 5 years. Provision for any provision for early redemption. Hirer can pay off the loan and take ownership earlier. Fixed installments and schedule. Repossession provision upon default of payment. So in case the user can't pay anymore, the owner can take back the asset. And other provisions. Who pays for maintenance and the insurance. Penalty for late payment, etc. Other features of hire purchase. Conserve working capital. So your CA, current asset, is higher. Pays on small installment to get the asset, not the full price of the asset. You pay fixed interest rate. The PMT is fixed until the end of the hire purchase period. It's a speedy processing. It's faster. The hirer obtains ownership on last payment. Listing. What is listing? Firms, lessee, rents the use of an asset from the owner, lessor, who contracts out the assets. Owner, lessor, retains the ownership of the assets. Examples: Elvis rental, car rental, photocopiers or machines, etc. Other features of listing generally is to conserve working capital, avoids restrictive covenants, restrictive provisions of term loan, may prohibit improvement on leased assets. Lease agreements will be direct lease, sales and leaseback, leveraged.